Hi, I'm Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Joining me today is Nick Leach. Nick is a portfolio manager with us and is also responsible for our income producing aspect of our portfolio. Welcome, Nick.
Thanks, Mike.
Good to have you here. So I guess before we dive into some of the things we're seeing in the income market, income producing or fixed income markets, why don't we, if you could just describe for the listeners what's encompassed in income producing?
For our clients at IAIC, income producing includes corporate bonds, which pay a fixed coupon and have a fixed maturity date. It also includes preferred shares, which are primarily floating, but so they'll pay a fixed dividend for, say, for example, 5 years, and then that dividend will adjust to what a spread over the 5-year Government of Canada bond yield. And there's some preferreds that adjust more frequently than that on a 90-day basis. And then there's also real estate investment trusts, which are technically equities, but they do pay also a fixed distribution that typically grows over time as the real estate investment trust issuer grows its business over time.
So between the bonds and the preferred shares, give me a feeling for the quality. I mean, obviously that's always let's face it, a lot of these you're basically, well, especially bonds, you're basically lending the entity money, so to speak. And so talk to me about the quality of that.
Oh yeah, well, all of the bonds that we're investing in, they're all investment grade rated bonds by the rating agencies. So if you look at the Canadian investment grade bond market, the risk of default is extremely remote. I think in the past 25 years, we've had one default, and that was Nortel. But that drifted into non-investment grade for quite some time prior to the default. So if you look at the marketplace over the 25 years, the issuers haven't really changed in decades. They're household names, they're banks, they're utilities, they're railroads, telecom companies. We buy their products every day. We use their services every day.
Okay, good to know. So given what's happening with interest rates, talk to us about what's going on in the income producing markets.
Yeah, well, this year has been quite a year for the fixed income markets. We did see the sharpest increase in central bank policy rates at an unprecedented pace. We went from 0% to 3.25% in a matter of months. That's not just in Canada and US. This was happening globally, and it's happening simultaneously. And that's also unprecedented. We've never seen global rates increase at this kind of pace simultaneously. So it's created a huge amount of market disruption, and not just the bond market, but we've seen it in the equity market. We've seen it in the preferred share market. So if you look at government bonds, for example, which are guaranteed as to principal and income and coupon, these risk-free bonds are down almost 15% this year.
15%. And so maybe just for the listeners, explain the mechanics, like why, these are, the drastic drop, because if interest rates rise, we're seeing these drops. Maybe just explain. And
it's just simple math, because the coupon is fixed, right? So the price and the yield will fluctuate accordingly. So if we were issuing, say, for example, at the lows in 2021, government bond yields were less than 0.5%, close to zero. So the government could issue a bond at a 1% coupon or less. Now that the market yields have risen up so much in the government bond market, over 4%. So if the government wants to issue a new bond, it has to issue a 4% coupon, right? So those bonds that they issued a 1% coupon, now that price has to fall until the yield on the bond equals the market yield of around 4%. It's really just simple. It's division and multiplication. And there's no guesswork in it at all, right? With valuing these bonds. It's not like an equity. We know what the terminal value of these bonds is today.
And that's a really good point, that very unlike equity, it's an equation. And one thing for the listeners is just to understand the difference between the coupon rate. That's basically the interest rate you're getting paid back for your loan, so to speak, that you're giving to whoever the bond is for. And then the yield is actually that interest rate, if I understand correctly, it's the interest rate over the price at that point in time. So that's just the difference. Even though, it's also an interest rate, some people get confused between the coupon rate versus the yield. And that's really the difference, that if you were to take that bond, go ahead.
So the yield to maturity. So if you buy a bond with a coupon rate of 4%, and the current market rates are 4%, and so the yield to maturity is 4%, that bond's going to price at par, 100 cents on the dollar, right? But if you have a coupon that's paying 1%, that price has to drop, right, until that yield, the denominator has to drop until the yield equals 4%. It's just simple math.
Simple math. Cool. So how are our clients positioned then, given what's happening with interest rates and the yields?
Well, as I mentioned, the government bonds are down as much as 15%. The corporate bond, the broad Canadian bond market is down around 4%. Our clients, they're holding 1 to 5 year investment grade corporates, so they typically don't have a maturity beyond 5 years. The average maturity is around 3.5 years. So, and on the top of that, the corporate bonds, they pay an additional around 1.5% extra coupon in turn for the credit. It's called credit spread carry.
Right.
So our client bonds are down on average around 6.5%. So that's less than half of what the broad market is.
Okay.
So
basically, they're well positioned given the fact that we went corporate bonds, as you said, the spreads. So given what we saw with interest rates and yields, they were in a good position.
Okay. They are, and they might be looking at losses today, but if they hold to maturity, those losses will disappear as these bonds will mature at par. I think it's important. So in 2020 and 2021, when government bond yields were, as you said, less than 0.5%, we were buying these corporates with a yield to maturity of around 2%. And what's important here is that 2% was locked in at the time of purchase. Right now that those yields are higher, around 6%. This is actually one of the most attractive times to buy corporate bonds in the last 15 years. But if they're looking at those losses today, as long as we hold them to maturity, which is the strategy, those losses will disappear as that maturity date approaches.
And that's so important that clients get their statements, they're hearing these numbers and think, geez, I thought having that income producing would stabilize my portfolio to a certain extent. And in fact, it does. It's just on paper right now, you'll see the negative if you were to go and sell at this point in time.
Yeah. Well, traditionally, that's why we have a balanced portfolio, for example, half bonds, half stocks. And typically, when the stock market there's a flight to quality, usually the bond market goes up. This is, as I said, these are unprecedented times because it's the central banks that are really dictating what what the bond market is doing in the short end, and that's having spillover effects into the longer end of the maturity spectrum as well.
So you mentioned central banks, so let's talk about that. Obviously, they're cranking up interest rates to fight inflation. So any thoughts in terms of inflation moving forward?
Well, yeah, if we look at the inflation recently, inflation rates have hit, the highest rate in 40 years. That's in Canada, that's the US, that's globally. But that's an annual number. So that includes inflation that was happening over the last 12 months. So it's kind of backwards looking. I've been paying close attention to the month over month, the monthly inflation rate. And if we take the monthly inflation rate in Canada over the last 3 months, and we annualize that figure, the annualized rate is actually negative. And if we do the same thing in the US, it's on target at 2%. But and if we look at commodity prices, they're all falling. We can see what's happening at the pump. We can see the home prices are falling. Commodity prices are falling. Global shipping costs are falling. Used car prices are falling. It was unusual that they rose so much. So if all these trends continue in the short term, inflation should it appears to me that it has peaked, and that annual rate should be declining.
Well, let's hope you're correct. But based on the data, as you cited, it looks positive anyway in terms of looking forward. Nick, thank you for this. Very much appreciated. Thanks for joining us.
Great. It was good to be here.
And folks, if you have any questions, reach out to myself. And as always, don't hesitate to reach out to your portfolio manager. Take care. Bye-bye.